So, and it's related to the to value. So the question is about the non-GAAP metric EBITDA. If I had the power to extricate that term from the English language, it's not even a word, that would be my first decree. Honest to God. Okay, because it's nothing other than what those words stand for. Okay, you start out with something kosher, clean, pure, but not perfect, which is the GAAP compliant earnings. There are rules. You have to follow certain standards. And believe me, there are a lot of tricks we've seen to get around the spirit of the rule. But if you throw that out and basically say to companies, you come up with whatever number makes you happy, then you have ridiculous results. So because again, you start out with EBITDA, and then the next step is an adjusted EBITDA. Okay, so Valiant, just to give you an idea of how easy it was to spot this company was really a train wreck. The 4 years, I'll give you the numbers, 2013, 14, 15, and 16. If you simply add up the GAAP reported earnings after taxes, it was cumulative negative $8.6 billion. And if you looked at the stock charts during that period, you said, what in the world is the world crazy? 8 points, and we're not talking about restructuring charges. We're talking about a normal ongoing business where you take your revenue minus all of the expenses you have to subtract, negative 8.6 billion. The metric that they used was called cash earnings. They should get some Academy Award for picking out the most clever term. It sounds perfect. It's earnings and cash. So we know that earnings can be manipulated, but I remember I was doing maybe a few years ago a program to the investment students at Columbia, and this guy was sort of giving me a hard time, and I started quizzing him because he was very, very defensive about Valiant. What I found out later, he had worked at T. Rowe Price, and he was on the healthcare team there, and that was one of their names. So he was very, very defensive. And so I said, well, exactly what is that? And I sort of was like walking him along the whatever it is, the plank to basically, I said, well, is it earnings? Is it cash? Is it earnings that have been converted to cash? I sort of was leading him down there. He says, yes. I said, interesting. I said, well, there is a GAAP compliant metric that the auditors have to sign. It's called cash flow from operations, right? You start out with the accrual-based earnings, and you convert that to the cash. But their cash earnings started out with EBITDA, and they start adding back all kind of ridiculous things. So I think once you accept that EBITDA is an appropriate metric, then it's a Pandora's box.